Hi, my name is Ben DeFore, and this is a picture of me and my family. And I do long-term care insurance and work with clients nationwide. And this right here is what I want to talk to you about today. How much does long-term care insurance cost for a 50-year-old? And we're going to look at some different amounts. We're going to look at $2,000 per month, $4,000, and $6,000 per month. And we're going to look at the 0% compound, which means the benefit doesn't increase over time. And then we're going to look at the 3% compound rates, which means that the rates actually increase by 3% each year. So just to kind of, let's go ahead and just kind of start off at the $2,000 with no inflation. And first we'll look at $2,000, $4,000, and $6,000 with no inflation, and then we'll take a look at what it is with inflation. So when you buy a policy with no inflation and you have no partnership protection, you're basically hoping that the benefit you receive will be enough, that and your income will be enough, and that you hopefully will never, face a Medicaid spend down. And a Medicaid spend down is basically when your long-term care insurance policy is exhausted and you have to start paying for it out of pocket, and you start spending down your assets till you're broke. And of course, hopefully that will never happen to you. And by getting a long-term care insurance policy, depending on how you buy it, you could completely prevent that possibility. Or you could just drastically decrease the possibility. So anyway, getting right to it, for a $2,000 a month policy for 4 years, you get $96,000 per person. You can see what the rates are here. $29 a month for a male, $45 a month for female, and of course $75 together. Now this is shared care, so in this case with being a couple, you would actually, one person, if you spent through all of your benefit, you would have access to the other person's benefit as well. So you'd have a total of $192,000 of benefit to divide between both of you. And the nice thing about shared care is once one of you passed away, let's say the husband passed away first, then afterward you would only have the $45 per month in premium to pay at that point, but you'd still keep all the benefit. So those are just some things to consider. Now these are also select rates, which means they're not the best rates. If I showed you preferred rates, it would be slightly better than everything you're seeing on this screen. So anyway, you can see what $2,000 per month is. Let's go ahead and look at $4,000. That's basically everything, just the benefits doubled. Everything else was the same. And you're looking at $150. So in this case, you're hoping your $384,000 of benefit is going to take care of everything, and you won't need anything more than that. And of course, hopefully that will be the case. Now, a $6,000 per month benefit, of course, you can see that, I chose the wrong option there, excuse me. A $6,000 a month benefit with no inflation, of course, is just $225. So basically it's increasing by $75 for the couple. As you kind of raise the benefit up, it's pretty much the same amount of increase. So there's kind of your base policies with no inflation protection, gets you kind of some good coverage, and you basically just kind of hope that that's going to be enough to take care of all of your expenses that you're going to have. If we look real quick and see what the cost of care is, you can see that today the cost is around $4,000. This is the national median we're looking at here for home health care or assisted living. And then for nursing home care, the national median is $7,441. Now, of course, if you live in rural Mississippi, it might be a little lower. And of course, if you live in New York or California, then it's going to be significantly more than that. And I went ahead and calculated what the predicted cost is going to be in 25 years. Now, this is based on a cost of care study, and it's basically going to be a little bit more than double. So you can see it's going to be $8,000 approximately in coverage, and a nursing home is going to be $15,000 in coverage. So the first three policies we've looked at, you're basically you're going to have to pay a little bit of money out of pocket from your income to pay for this care. And of course, if a nursing home happened, then it's not going to cover everything for sure. There are many cases where people get a stroke in a nursing home for 12 years, and they completely spend down their funds. So now let's go ahead and look at some of the compound inflation options that have partnership protection. Now, the first thing to quickly explain is, what is partnership protection? When you put a 3% compound on the policy, now there's about 8 states that will allow a 1% compound, but typically you have to have a compound inflation protection on the policy for it to qualify for partnership status. Partnership basically means that the insurance company has made a deal with the state, and the state has agreed that if you get this partnership, qualified policy, then whatever the partnership policy paid out in long-term care benefit, the state will allow you to keep. So let's say you get this $2,000 per month policy, and let's say 24 years later, the benefit has compounded at 3%, and after 24 years, a 3% compound doubles your benefit. So you would have had $4,000 per month at 74 years old. In that case, your benefit pools would also be doubled, so you'd have approximately $384,000 in benefit for long-term care insurance. That's because after 24 years of that 3% compound, your benefit amount and your benefit pool has doubled for each person. So let's say you had a $400,000 portfolio at that time, and then you need long-term care, you spend through your entire policy. In that case, Medicaid would allow you to keep $384,000, and they would continue paying for any care that you needed beyond that, because you got that partnership protection. Now, with a normal policy, what we just looked at, you wouldn't have that. If you went with the 4,000 with no inflation on this policy here, then in that case, you actually would not, once you spent through that 384, you'd have to spend down to $2,000 again. Now, with this $2,000 per month with the 3% compound, after 24 years, it will have doubled. In that case, you would get partnership protection, and that pool of money would be protected from Medicaid. So you would guarantee that your heirs would inherit it, and also if you're the second surviving spouse, then you can be thankful that you're not broke once your first spouse passes away, and you can still have a good standard of living until you're living out your golden years. So this is what the cost is for this policy, $161,888. So slightly more than the $4,000 policy with no compound inflation. But as you can see, assuming that you do need care later on, then this would be the better way to go versus the $4,000. Now, if something happened earlier, then obviously the $4,000 policy might be better. So now let's kind of look and raise the stakes a little bit. And let's say maybe you have $500,000 or $750,000, or maybe even close to $1 million in assets. Then you might consider some policies like this: a $4,000 a month benefit, and it covers a 3% compound. In this case, after 24 years, it would pay $8,000 per month. So that would completely take care of an assisted living or home care, and it would put a pretty good dent into a nursing home care. And of course, naturally, you're going to protect a good portion of your assets. So even if you did stay in a nursing home for quite a while, you'd be happy to know that a good portion of your assets would be protected from Medicaid. So 24 years later, your pool of money would be close to $800,000, because these numbers would double. And of course, that would provide you some good protection. And in this case, you'd pay $323 per month for both of you for that benefit. Now, of course, as I said, these are not preferred rates. If you had good health, it'd actually be cheaper than that. And now let's go ahead and look at the $6,000 with the 3% compound. So in this case, 24 years later, that $6,000 benefit is going to be $12,000. So naturally, that's going to, cover most of a nursing home if it were to happen, and might put you in a pretty nice assisted living facility, maybe, an upscale facility, that you'd no doubt would enjoy better. Of course, it does come with its cost of, $485 a month in this case. But if you're looking at this policy, you're probably in a position where, you wouldn't sweat that too much. And this would protect approximately close to $1.15 million in assets in 24 years. So, if you did go beyond these policies and needed more care, then a very large portion of your assets would be protected, depending on how much you had. So typically when we look at these different types of policies, you're going to find that people who have anywhere from 50,000 to maybe 350 or 400,000, they might choose an option that has no inflation, maybe a $2,000, $4,000, or $6,000 inflation, or maybe a small partnership policy that you line it up to where it's going to cover you for $300,000 if you have $350,000 in assets, so it protects a good portion of your assets. Now, and then once you kind of get toward the higher amounts of policies, that's when your assets are going to typically start climbing higher. Maybe your portfolio is $750,000 or $1 million, and once you start getting beyond $1 million, you either are going to pick a good partnership policy, such as one like this, maybe even a better benefit, or somewhere around those numbers, or you're going to consider what's called a hybrid policy. Once you get above $1 million in assets, then you can start to afford some other options. So I'm going to kind of show you just a few options. Of course, these can get very detailed and intricate, so I'm just going to give you a few examples of just an example of how it would work. In this case, you'd put up $75,000 for both of you to cover all of your long-term care. You'd have a $3,134 monthly benefit for both of you to start out, and then that would compound at 3%. And this particular product has an unlimited benefit rider. So in that case, you would actually have coverage for an unlimited amount of time, so it would pay that benefit for as long as you needed it. In this case, partnership protection isn't as big of a concern because you have an unlimited benefit. Of course, now, and then the nice thing about these policies is if you don't use it, then you'd be able to receive a death benefit. Your heirs would receive, this death benefit of $78,000 if you never use the policy. So, just something to consider. And then here's another one at $100,000. Typically, $50,000 per person is typical. But when you're 50, you can kind of go a little lower than that, or and as you kind of get older in years, you might have to put up a little bit more money to get the benefit that you want. So once you kind of start getting over, if you are over $1 million in assets, definitely we can kind of talk about some different hybrid policies that are available to you. I'd love to kind of do a screen share with you, kind of come to a calculation of just the exact right amount of benefit for you, discuss and answer all of your questions about your particular state, what the partnership protection is like in your state, and just look at all the different options and find the best policy that fits your situation. I hope this video has been helpful for you, and I would love to help you with long-term care insurance. And if you go to my website, www.longtermcareinsuranceprofessional.com, you can get my book for free. It actually does cost money on Amazon, but just by filling out the quote request form, you get the book emailed to you for free. And also, if you'd like to call me, I'd be happy to help you and give you free quotes and help you with any of your long-term care insurance needs.